Hello, and welcome back to our continued discussion dealing with Chapter 12, some lessons from capital markets. In this video, we're going to be talking about risk premiums. So what exactly is a risk premium? Well, it's the reward for bearing risk. The risk premium is the difference between a risky investment return and the risk-free rate. So we'll be using the T-bill rate as the risk-free return and aggregate common stock as an average risk. So we're going to define excess return as the difference between an average risk return and the return on the T-bill, okay? So let's look at the average annual returns in the risk premium, right? So what do we see here? Well, here we see the average returns for large stock, small stock, large corporate stock, or long-term corporate stock, and long-term government bonds, as well as T-bills. So in order for us to calculate the riskiness of the investment, um, we're going to, again, take the average return and subtract the U.S. Treasury bills return. Why? Because remember, we said that U.S. T-bill is what we are using as the risk-free return, okay? And again, we're just taking the average return for each of those investment classes, excuse me. So let's look at the large company stock. The average annual risk premium has been approximately 8.6% since 1926. For smaller and presumably riskier firms, the average annual risk premium has been 13.2% over that same period. And what this really says to us is this really is the first lesson within capital markets, right? And the first lesson really states that, hey, anybody willing to accept the risk is going to get rewarded for it, okay? If you are willing to take on a risk, you will receive benefit or you will be rewarded, okay? And that's what we're seeing here. We're seeing that the risk premium is calculated by taking the average return and subtracting out that return for the risk-free rate, right? So the difference there is that risk premium. So look at the small cap stocks, right? The small company stocks, they have a risk premium of 13.2%, right? Presumably those are smaller companies, maybe a little bit more riskier. So in order to entice investors to invest in those riskier companies, they need to earn a higher return, right? Or they're willing to accept risk, so they should be rewarded as such, okay? Now let's look at the frequency distribution and variability, okay? What we have here is the frequency distribution of returns on the large cap or large company stocks. So if you notice that the majority of these fall between 10 and 20%, which is that 12% was the average return. So we could see here that the average return is that 12%. So we're taking our table here and just kind of looking at this in frequency distribution form. Okay, so what is variance and standard deviation? We're going to really look at the variance and the standard deviation, and we're going to calculate these. And the reason why is these are the most commonly used measures of volatility. Okay, so when we're thinking about risk, we need to look at volatility. Okay, if something's volatile, that means it's uncertain, right? Or the higher the volatility, the higher the uncertainty, right? And that in turn means we're accepting risk if we invest in that. Okay. Excuse me. So we're going to be looking at variance and standard deviation. Remember, variance, this is the average squared deviation between actual returns and their mean. Okay. The standard deviation, that's just the square root of the variance. So we will get into some practice calculating variance as well as standard deviation. Again, when we're looking at the historical variance, we're calculating the historical variance rather by taking the sum of the squared deviations from the mean, and then we're dividing it by that number of observations minus 1. Okay, so that's pretty much how we calculate historical variance, or calculate variance really. And we will be working on these, some examples of these in class. Okay, so let's look at what we have here. What we have here is the example of variance as well as standard deviation. Okay, so what we did was we took the actual return, and we could go, bear with me here. Okay, so these are the years that they're looking at. So they're looking at the actual return, and the actual return was 15%. The average return between that time period was 10.5. Okay, so we take the deviation from the mean, that's our 0.045. We do that for years 1 through 4. Okay, and we will be working on an example of this in class as well. So we see that the variance is rather easy to calculate, and the deviation, the standard deviation, is our 0.0387. And remember, the standard deviation is the square root of the variance, right? So these squared deviations, these are the variances that we're calculating. Okay, so we see here that the variance for all 4 years is 0.0045. We have 4 observations, so we're going to take that squared deviation, or that variance, and divide it by 4 minus 1. We get 0.0015. Okay, and again, we'll be working on these in class as well. Don't worry about mutual funds. We'll talk about that a little later. Very important here, the arithmetic versus the geometric mean. Okay, this, for our purposes, we will be mathematically calculating, if you will, the average the average, or the arithmetic average. We're not going to get into the geometric averages. You do need to know the difference, right? So what's the difference? Well, if we're looking at the geometric average, this is the average compound return earned per year over multiple years. The arithmetic average is the return earned in an average year over multiple years. So the main difference here has to deal with compound return. Okay, the geometric average takes the average compound return earned per year over a number of years, where the arithmetic average says, hey, what's the return earned in an average year? Okay, so we will get into some calculating these. When it comes to which one's better, which one's worse, well, arithmetic is obviously a little easier, right? The geometric average takes a little bit more computation, okay? The geometric average will actually be less than the arithmetic average, unless all returns are equal. Now, all returns are not going to be equal. We're going to fluctuate from year to year to year, okay? Again, which one's better? Well, it depends on our time horizon, right? If we're looking at the arithmetic average, if we're looking over a long horizon, it's going to be very optimistic. The geometric average is very pessimistic for short horizons. Okay, and again, which one's better? Well, it all depends on our timeline, right? What is our planning horizon? What's our planning period, right? Are we looking 15 to 20 years? Well, we're going to use the arithmetic. If we're looking at 20 to 40 years, we might do it different. We might split the difference, right? Between them, we might, some of them we might do arithmetic, other ones we might do geometric. If we're looking at 40 plus years, we're going to use the geometric. Okay, so the longer the period that we're looking at dictates which method is better, and the longer we're looking, we're going to use the geometric difference. Okay. Again, in class, we're going to work on how to calculate those arithmetic averages. We won't get too much into the geometric averages, just the arithmetic averages. When we come back in our next video, I want to look at, or want to talk about really, capital market efficiency. What is it? So tune back in for that video.